Hi, Thomas.
Hi, Charles. Am I audible to you?
Good afternoon, everyone.
Yeah, good afternoon. If you are audible, would you please check your presentation? Charles, this is Sandeep speaking.
I've got it. So, Sandeep, how are you?
Yeah, I am wonderful. You check your presentation first, then we'll start.
Yeah, we still have 5 minutes to go. Yeah, till the time you can check the.
Is that good?
Yeah, can you turn on the pages, please?
You see that?
Yeah, perfect. That's perfect.
Thank you. How's the sound?
Yeah, Charles, is this the first time on WebEx you're working?
I've done a few on here. We use Teams as a standard, though, so I might not be as familiar. Is my sound coming across okay?
Yes, yes, it is.
Great.
Yeah,
I
your
can
sound
use
is
the
okay.
I can use the headset otherwise, but
No, sound is okay. But unfortunately, I am now coming. It may make a problem.
oh, I'm sorry to hear that. I've got a slight lag. I don't know if that's me or your end. I'll see you online at the IVS meeting, Sandeep.
Good afternoon, sir.
Hello. Just cue me in when you're ready. Let me know when it's time.
And now here it is another 1 minute left. So after that, Rahul will start the program.
Raul will. Fantastic. Thank you.
Yeah.
Yes, hello to everyone. Today we have a fifth session on the IVS 2025 standards. And today we have Charles Golding as well. And of course, Sandeep Kumar Dev sir is also there. I would like to give a little brief about Charles. He's a senior specialist in valuation and investment advisory at the RICS. And of course, he's developed global professional standards for valuers, including the RICS Red Book, and collaborates with stakeholders ranging from multinational firms to local professionals. He's an expert in ESG and has contributed to sustainability guidance and serves on the IVS tangible assets ESG working group. That's it. And with a background in chartered valuation surveyor, he has expertise in development, investment valuation, and lease advisory, including serving as an expert witness in the UK Upper Tribunal. And of course, we also have Sandeep Kumar Dev, sir. There'll be little technical problem with him time, but yeah, just bear that. So, Sandeep, sir, would you like to say a few words?
No, thank you very much, Rahul. Actually, welcome everybody to this IVS 103 program. So I would not like to spend any more time in other way. Now, I would like to hand it over to Charles. Charles, you can start now. Thank you, Charles.
Good afternoon, everybody. It's morning for me in sunny London. If I just move to the side there, you can see the famous landmark, Big Ben, and the Westminster Palace there as well. So I'm from RICS HQ today, and it's great to be with you all. And because I'm English, I have to give a quick weather report. So I see that in Mumbai, it's 26 degrees and sunny. In Delhi, it's 27 degrees and sunny. In Chennai, it's 31 degrees and sunny. In London, it's 7 degrees and mostly cloudy, which means it's grey and raining. So I hope you're all gearing up for a fantastic weekend in the sunny weather, and I'm very jealous of you all. But before we get to that weekend, I want to give you an important update on the latest IVS 103 valuation approaches. And because I'm a valuer in practice as well as for RICS, I have to give you a series of caveats as well. And the most important of these is I'm going to be, of course, talking about the International Valuation Standards. I don't work for the International Valuation Standards Council. And throughout the slides, rather than just using the entire standards themselves, I've used précis or summary versions. So what I don't want you to do is copy and paste anything from my slides, which will be available after the event, and use them in your own practice documents. Please do refer back to the IVS standards. We've had a little bit of a biography for me, so no need to go over that all over again. But just to say, I am a member of the International Valuation Standards Council Tangible Assets Board, and I also work for RICS. And although this is an IVS presentation today, I'm going to give you a little bit about the Royal Institution of Chartered Surveyors Global Standards as well, and just talk very briefly about how we as a valuation professional organisation integrate and incorporate international valuation standards. I'm also going to present a few of my own personal views, and I'm going to try and make that very, very obvious. So you'll see where the slides are IVS slides, and I'll flag where I'm just giving a personal view about valuation approaches themselves, just to be clear about where I'm saying this is what IVS says and where I'm saying this is what I think. I think those two things are useful to present to you today. Hopefully we're going to have the chat function. I hope we are, because I love to speak to all the audience, both as I'm presenting. If we get a little bit of a chance for questions at the end, I'd also appreciate that. In the biography, you might have seen I am a specialist in commercial real estate valuation. And I know that many of you on this call will have expertise in business valuation, plant and machinery, potentially financial instruments as well. We as valuers always know to stay within our competence and experience and not go outside that. And that's very much what I've done with this presentation. So I won't be able to answer your specialist questions on plant and machinery, but I do hope that I've set it within the context that I understand. And if you did have any technical question that I'm not able to respond to today, I will look to get an answer to you at a later date. I've made a few assumptions because I'm a valuer. I've made the assumption that you know something about IVSC and IVS. I don't know if anyone in the chat or using emoticons could indicate that through a thumbs up or just say yes or no. I'm assuming that some of you at least have read the International Valuation Standards and are aware of the work of the International Valuation Standards Council. I'm not going to go over all of that today. I'm also made the assumption that you've probably gone to some of the other sessions as well. If you haven't, again, I'm not going to recontextualize all of those today and go back over that ground. I would recommend either going to the standards themselves or, if available, going to the previous presentations. And of course, there's further presentations to come on this excellent series as well. I'm going to stick within my lane today and talk about valuation approaches specifically. Let's start with a definition. I did a seminar at a university last year, and I talked for ages about ESG, and someone put their hand up and said, I don't actually know what ESG is. So environmental, social and governance. Let's not get into that. That's not the subject of today's talk. But the reason I referenced that anecdote is because let's start with the definition. Let's start with what we're talking about. I'm probably going to prejudice the later presentation here, but I think the definition of valuation approach is pretty simple. I also think it's a little bit misunderstood as well. And for some people in some markets, it's a relatively new concept as well. They will use different terminology. What does IVS say? What's the definition of valuation approach within the IVS glossary? A generic term for the use of the cost, income, or market approach. All it does is reference those three approaches: cost, income, market. Not much further detail. We'll look at further detail today, but from that basic definition, that's the takeaway. We're talking about three only approaches: cost, income, or market. And I think it's something of an achievement that the International Valuation Standards Council and IVS have taken all of the valuation work that's done globally for all different asset types, be they business valuation, financial instruments, real estate, whatever it might be. And they've come up with three approaches that cover all of that. But what that means is they're going to be high level and they're going to be principles based. But the simple definition: cost, income, or market approach. I mentioned that I'm not here to talk about the model session that's coming later and the previous sessions covering the IVS framework in general. But I think we should talk about approach within its context of the approach, method, and model of valuation. The approach is essentially an umbrella term. Underneath the approach, there are many, many different methods that people use for all of the different asset types that they're valuing around the globe. I've just, simple example here, I've taken the income approach. I've looked at some examples of methods that sit under the income approach. And I absolutely stress and underline that that's not every method. Again, we don't need to screenshot, we don't need to copy and paste. I'm not trying to say there are only three methods under the income approach. There might be many, many more. But the umbrella term is income approach. Underneath that sits whatever method you use. And then through IVS, we have the quantitative implementation of the method, which is referred to as a model. And you can see that we start at the top around income approaches in quite general principles terms, and we get into more detail as we go through the different layers. I mentioned these are examples only, and don't get too het up about the models that I've referred to there. You might use many, many different model types. You might use different service providers and software providers to implement those models. You might develop your own spreadsheets. You might use your own models and formulas and a way of putting together a discounted cash flow, for example, that I haven't gone into detail here. But this is the general framework with the approach sitting at the top as an umbrella term above everything else. I thought I'd highlight when I'm giving a personal view, and I just wanted to talk about some top tips in relation to valuation approaches. The first of these, for me, and it might be a bit of an English-centric idea, but approach is a pretty common term that's used in everyday English. And you get into this ludicrous situation that I've put on the side of the slide there, where people create these sentences that the approach I took was to approach the valuation in an approachable way, which required a valuation approach. Well, all of those are meanings of approach, but we're talking about something very specific and a defined term within IVS. So as a sort of general rule of thumb, I try to avoid using the term approach in its everyday context in evaluation terminology or description or within the valuation report itself, where I mean valuation approach specifically in terms of the definition within IVS. As I've already said, terminology can have vastly different meanings at a jurisdictional level. Your local rules within each state, your local licensing and legislation might use different terminology for valuation. That's okay. The IVS framework allows for that. But what IVS does brilliantly is draw together the common principles and allocate them under the umbrella approach terms that we've talked about. But just be careful within your own reporting, within your own work, not to mix and match terminology all over the place to the point where the reader, the user of the valuation can't understand it. Try and keep the terminology as consistent as possible. I'm going to say this about valuation methods as well, but it's important for approaches that we mustn't be afraid of multiple approaches. We can, when we do a profession over a number of years and for the same intended uses, you can get into a mindset that this is the right approach, this is the only approach, this is the one we've always done in the office. Consider multiple approaches. And actually, when you are short of evidence, when the market is uncertain, multiple approaches and multiple methods are your friend. Now, you don't want to use so many different approaches and methods that you can't come to a single conclusion that you present, which is often what is required by the client, depending on the valuation circumstances. But you can use the different approaches and methods to cross-check, to substantiate the answers in relation to the other approach or method used. So don't be afraid of multiple approaches, in my view. And the other one for me is don't just jump to the selection of the approach. I find it all the time with valuation that my instinct is to jump to the approach or the method. Let's start at the absolute basics. What is the asset or liability that I'm actually valuing? Because that's going to dictate a lot about the approach. The second thing that is going to really dictate which approach to use, what's the intended use of the valuation? And within that, what's the intended user of the valuation as well? Why are you doing the valuation? If you're doing it for secured lending, you might use a different approach to if you were doing it for a tax regime, which has a specific legal basis, which means you have to use a certain approach. So the intended use of the valuation can often dictate the approach. And once you've considered the asset or liability and the intended use, you're then going to have a basis of value from that, be it market value, be it investment value or worth, be it fair value, or be it some other defined basis that's relevant to your jurisdiction and market. And that basis will also give you guidance towards the approach and methods to use. In some circumstances, it might not be appropriate to use a particular approach for secured lending or financial reporting or whatever the intended use and therefore the basis will be. I appreciate this is pretty simple stuff, but it's about getting back to first principles and not just jumping to the method and the approach, which can be something, I don't know, I might be speaking personally there, we as valuers might do. Don't worry, I'm not just going to talk in general terms. I did want to just go through each approach, its terminology and its definition itself. I've only got a half an hour short presentation today, so let's not pretend that I'm going to get into the detail of every single page of IVS, and I'll constantly use the refrain throughout this presentation, go back to the standards, read the standards themselves. We've had some feedback at the top of the call that many of you are already well steeped in them. I'm going to start with the cost approach. What I should say is this is no endorsement of the hierarchy of approaches. I've done them in alphabetical order, I think. I think it's alphabetical order. So I'm going to start with the cost approach. What is the cost approach? Well, according to IVS, it's an indication of value using the economic principle that a buyer will pay no more for an asset than the cost to obtain an asset of equal utility. It's basing the value of an asset around its adjusted costs for replacement or reproduction. That's the cost approach in essence. However, for caveats, there are decision processes you should make before using the cost approach. And in my personal experience, and it might be different within the market that you're operating in and the intended users that you follow, but in my experience, the cost approach is the one that needs the most standing back and look, thinking, is this the right approach to use within these valuation circumstances? Because you've got to consider whether participants will be able to recreate an asset with substantially the same utility as the subject asset without the regulatory or legal restrictions that are referred to in IVS, for example. And they need to be recreated quickly enough that the participant would not be willing to pay a significant premium for the ability to use the subject asset immediately. So the concept, although it is conceptual, there has to be some grounding in reality around whether that concept is reasonable. Now, the second point that contained within IVS around the sort of times you should use it, I think is really interesting. And what it says is you should use it where the asset is not directly income generating, because then I think the income approach might be more suitable. And the unique nature of the asset means that using the market approach or the income approach wouldn't be feasible. And that it's not stressing a hierarchy within IVS. So this is my own overlay of that. But what I will say in the RSCS Red Book Global Standards is we add a sort of additional thought to that suggests that the cost approach, you should have some care and reticence around it, as I've implied. Cost doesn't always equal value. It probably rarely equals value. That means you need to make a lot of assumptions and adjustments within the cost approach. And it may be my personal experience, but I tend towards going for market-orientated approaches first, or approaches that will consider directly market implications and behavior, be it the market approach itself, or be it the income approach from which you would derive or for which you would base market evidence. So sometimes the cost approach is referred to as a last resort, but there's many circumstances where the cost approach would be your first resort because of the particular valuation you're doing, because of the particular market you're in. But in general terms, and let's look at those two criteria. Is it income generating? Is it of a unique nature? That then means you couldn't perhaps use the other more market-linked approaches. Coming on to the income approach, that's what it is on the tin, really. The income approach provides an indication of value by converting projected cash flows to a single current value. And of course, those projected cash flows are going to be based around the evidence that the valuer finds and should have some, in many cases, should be derived from the market, should be derived from actual transaction and related evidence. So yes, you can use the income approach to do a value that isn't necessarily market derived, but in many circumstances, that's what gives its grounding. The times we would use the income approach, when should you use it, is according to the International Valuation Standards, when the income producing ability of the asset is the critical element affecting value from a participant perspective, or you would look at reasonable projections of the amount and timing of future incomes, and they are available for the subject asset. But you're not then just mainly basing it on market comparables, in which case you would use the market approach. So throughout this IVS framework, it's actually cross-referencing not only the individual approach you might be looking at itself, but how and when you might do it in consideration of the other approaches as well. Finally, the market approach. The market approach provides an indication of value by comparing the asset and or liability with an identical or comparable that is similar, that is a similar asset and or liability for which crucially, for which price information is available. And the market approach must, I'm going to say must, it says should within IVS, but in the context of using it in practice, I think it's crucial that you take in account of the frequency of transactions, the number of transactions. I'm of course talking about within a real estate context, observed pricing and the proximity to the valuation date of the transactions that are being used. How relevant is that evidence? How much evidence do you have to support the approach taken? Because otherwise, perhaps you might be leaning towards another approach where you're in circumstances when there is no evidence at all. When is it particularly appropriate to use the market approach? Well, the subject asset has recently been sold in a transaction appropriate for consideration under the basis of value. We're talking linking it back to the basis of value, as we mentioned earlier. Another example is the subject asset or substantially similar assets are actively publicly traded. You have comparables. There's public trading of them that you can then use as evidence to support your approach. A couple of examples here, and this is when we're going to do a little bit of homework. In the chat, someone just post the approach that might be good to use to value a hospital, as a piece of real estate. Anyone in the chat? Deval's gone income. Yeah. I'm being a bit, if it's a bit of a trick question, really, because let's always link it back to what is the asset being valued, what is the intended use, why are you doing the valuation, and therefore what is the basis. And Deval's absolutely right. If that's a private hospital that's generating a lot of income within a market that has a healthcare system which is income generating, and you can provide income related comparables and evidence to support that, the income approach might well be the viable one to use. You might have situations where lots of hospitals are being transacted in the market, and the market approach might be used. I'd suggest that in many markets that might be rare, although there are clusters of real estate where hospitals might be traded. And therefore, we come to the cost approach, which in many markets might be the sort of thing that's used for a public piece of real estate, a public hospital for which there might not be any trading of the asset, for which there might not be any income. But a few of you, because of the terminology that we use that's different in our local jurisdictions and markets, have used different method terminology within the chat, and that's obviously okay to do that. But I will just refer back to, in IVS terms, there's only ever three approaches: income, market, and cost. There's only ever three approaches. I'll turn to the next example of a resort hotel. That looks pretty nice. That'll get me away from my my grey London weather in the background there. The water looks pretty good as well. What might be typically used as an approach? Let's give you an example of someone's trying to take some lending out against this hotel. What might be the approach, do you think, that would be used to value it, as a guess, or even as having knowledge of valuing resort hotels? Yeah, exactly. I think a hotel, a resort hotel might be something that's an asset that would typically generate an income on which you'd be able to provide provable evidence of that income, and therefore it might lean towards the income approach and what's referred to in IVS also as the profits method that might be particularly suitable for trading assets. But also, what if it hasn't traded yet? What if there are no other hotels anywhere near this one? This looks like a pretty remote island. Potentially the cost approach, but let's look at that caveat that we made around the cost approach and the limitations of it, the assumptions that need to be made, and perhaps let's look at the market approach and income approach first. Maybe we'll need to go to a wider base to get our evidence. Maybe there are examples of transactions related to these. It's not always a simple answer. And what did I say earlier? Let's maybe do a mixture of approaches. Are they coming to wildly different answers? Are they supporting each other? Can we cross-reference the different approaches as well? A final example, just a nice house on a very colourful street there. Our house is the yellow one that we're looking to purchase, and they want a valuation to support that purchase. What typically might we use as the approach to value a rather vanilla looking house? I don't think we've done a survey. There's nothing particularly wrong with it. There's not a leaking swimming pool out of the back, or the roof's not falling in. It's in pretty good nick. What might be a typical approach that we'd use to value a house such as this? Again, yeah, I have Suresh, I have Deval. Well, again, thank you, market. Again, in many markets, there might be good transaction evidence related to the residential market, and therefore you can use those comparables to support the use of the market approach. So in many markets, the market approach might be the first point of call. It might be an investment. It might be let to students. It might be multi-let. It might contain a load of bed sets. Therefore, it might be an Airbnb. It might be other tourist room providers are available. It might be a serviced apartment of another kind. So you could, in certain circumstances, lean towards the income approach if it is an income dividing asset. I think it would have to be a very limited market and no evidence of income before you would start to get to the costs approach. But we've mentioned circumstances where you might start to lean towards that. It might be social housing in an area with no income evidence, with no market evidence. But again, we need to be careful and we need to cross-reference where we can. So approaches summary, let's turn to IVS 103. It goes through each of the approaches for you. IVS 103 doesn't just include approaches. It's the approaches that are mandatory as a first port of call, but it does also have an appendix which refers to methods separately. The application of those methods themselves isn't mandatory. However, if you do use one of those methods that's within the IVS framework, it's mandatory to use the terminology, the description, the application that's suggested within IVS. So I hope I've been clear about that. It's not saying you must use this method, but it is saying if you do use one of those methods, use it in accordance with the IVS framework. You'll be very pleased to know I'm not going to try and cover every single valuation method there is potentially for any asset class all over the world. But I think maybe let's just go through the definition and a few examples. So what is a valuation method in accordance with IVS? Well, within a valuation approach, it's a specific technique to conclude a value. So we take the approach, the high-level approach. Within that is the specific technique, the method to conclude a value. And again, just go through some examples. The comparable transaction method, very common method used across many different asset types and markets. Generally, you want to have a good volume of comparable evidence where you can. You don't necessarily want to be relying on a single example of a transaction. You can look at prior transactions related to the asset itself, although there are restrictions around that in certain valuation circumstances globally. Now, this is one that we come up with a lot in terms of queries that we get, in terms of how the market works. Not all markets have available comparable evidence in terms of land registries, lease registries, cadastrals, public information related to transactions and sales. And therefore, in some markets, there can be more of a reliance placed on listings, conversations that you would have with capital markets, with agents operating in the market, looking at asking prices, looking at their sentiment related to the market. We should have great care when looking at this evidence. And it makes it very clear within IVS that this probably should not be used as the sole indication of value. It might steer you towards a path of relevant participants to talk to and relevant evidence to look at. It might give you parameters, but ultimately we would establish transactions are a far more powerful piece of evidence. So how do you actually put together the comparable evidence that you've used? Well, as I mentioned, several transactions generally preferable. Try and get the transactions of assets as similar as possible as a first principle, because if you get similar comparables related to similar assets, you then don't need to do what is ultimately subjective analysis and adjustment. But once those comparables are different to the subject, you know you will have to go through that process of analysis and adjustment in order to consider them as comparables and as evidence to support the comparable transaction method. So it's crucial, and I've just given a few examples here. There's a great long list of them within IVS of what you're looking at in terms of similarity and where you might want to adjust and analyze. So age, size, specification of the real estate asset, for example. There might be restrictions on the asset itself, which mean it's not a great comparable. There might be restrictions related to the subject property that mean you might then overvalue it because you're looking at comparables that don't have those restrictions. It's a bit of a cliche around real estate, but of course, location can have a huge factor in terms of the value of property. You could be next to a tourist square or a station and have a huge value attached to an asset. You can go one street back and the values have changed quite significantly. And it's not the subject of my speech today, but it is something that I specialize in with RSCS. ESG considerations within the assets now. And just to note that IVS now includes mandatory consideration of significant ESG factors at the terms of engagement and reporting stage. So it would be anathema then to ignore ESG considerations when it comes to the comparables. You're not just looking at the subject's ESG performance, but also the comparables themselves. A second example I've used is discounted cash flow. What is it? Well, under the DCF method, the forecasted cash flow is discounted back to the valuation date, resulting in a present value of the asset. If you want to get into the weeds on DCF, then within IVS 103, it talks about the different applications, the different use, different scenarios related to DCF. It's got some really great detail in there. So again, I'm not going to go into the weeds in an overview presentation today. But let's just look at some of the key steps related to the DCF. Ultimately, choose the most appropriate type of cash flow for the asset itself and the valuation. One of the criticisms of DCF is it can have a lot of moving parts. It can have a lot of assumptions and adjustments. You could cash flow over any number of years. You could make assumptions within that cash flow around income and costs. You have to. Do you need that level of complexity? How complex should it be? What should be the structure of the DCF itself? To make sure the actual cash flow you're using is suitable for the asset. It comes back to that thing I mentioned earlier about don't just use a pre-existing template because it's the one you've got lying around or it's the way you've always done it. Is it suitable for the asset and the valuation itself? Determine the explicit period that you're actually going to cash flow for. I get asked quite a lot, what is the the world standard on how many years there should be in a cash flow. Because I need to do a valuation. Is it 10, 15, 20, what 5 even? What is the world standard on that? There can't be a world standard on that, because I'll probably get contradicted to this in IVS somewhere. But ultimately, you've got to be suiting your cash flow period to the valuation, to the asset itself. It might be different depending on the intended use of the valuation. So there's no standard cash flow period, but you must make sure it's suitable. And there'll be evidence within the market, within the methods undertaken by other people, the models used of suitable cash flow periods. You're not going to have to be absolutely in the dark over that. Particularly in real estate, many discounted cash flows use a terminal value appropriately at the end of the forecast period. So you've got to determine that appropriate terminal value. And in some cases, that terminal value can be the majority of value. So it has a particularly important weighting on the valuation itself, and therefore must be derived, usually, depending on the basis of value, but should be at least evidenced and preferably derived, I'll say, with market relating, potentially transaction, or at least income related evidence. And I would say that for DCF in its entirety, it has particular application for if you're running an investment fund, if you're an asset manager, if you're looking at your personal strategy, if you're looking at a valuation on the basis of investment worth, you might be doing scenario testings around various outcomes. That's slightly different to, say, it's very different to doing a market value for, say, secured lending or financial reporting. You might be going around that, the assumptions that you use in a different way. So just be careful of that. And that comes up no more prominently than in application of the discount rate. Now, discount rates can be a bit of a dark art, black magic, bit of a mystery in some markets. In other markets, because DCF is the established method that's used to value a particular asset type in a particular market, discount rates are far more easily obtainable through market sources, through an analysis of transactions, because that's how transactions are analysed within a particular market. In other markets where the DCF method isn't as prominent, it can be harder to source discounted cash flow discount rates, and you can get more of a temptation to use those rates that would be used from the investor side to predict or scenario test the various investments. And you can then start to blur the lines between, say, market value and investment value worth, and some care and attention is needed again to make sure that you're linking your discount rate, if you're undertaking evaluation on the basis of market value, back to the market itself. And I'd place those same caveats around something like the weighted average cost of capital, because the cost of capital to who, weighted average to who? Is it to a particular occupier, owner, or is it derived in some way from evidence that would be relevant to the market? Again, I'll stress it, I'll underline it all the way through the presentation. Don't be afraid to use different methods. I said, don't be afraid to use different approaches. Don't be afraid to use different methods as well, both as a way of supporting the method that you use, the cross-check, to make sure that the answer makes sense after you stand back and look, and as an alternative as well. So here is the most boring office in the world. Let's say it is in a large city somewhere. What method might you use in the chat quickly to value this rather grey-looking office building? Anyone in the chat, give me an example of a method that you might use to value an office. Yeah, that's it. It depends on the market that you're in to some degree, because in some markets there's going to be lots of office transactions. So you might look at the market approach. You might look at comparable transaction as a method, because you have an established base of evidence to use. You might also look at the income approach. You might look at a discounted cash flow method. It might be a service office, a flexible workspace in which a trade-related, a profits method approach might be more suited as well. So there's no one definite method, but you can attach certain methods are more prevalent in some markets than others. And within the methods themselves, as some people have referenced in the chat, you might then use specific techniques, specific models, and specific considerations within those methods to actually tease out your valuation conclusions from there. And just some personal views. Firstly, I know there are cat people in the world. I'm a dog person, so one of my final slides is going to be a dog slide. So nice picture of a dog there. Select the method that's suitable for the asset type, the intended use, just underlining that point again. Don't be afraid to use multiple methods where it's appropriate to do so. Appreciate the nuance of the method that you've selected. If you're using, I know this isn't the models presentation today, but if you're using pre-existing models, pre-existing templates that apply a method, do you understand the actual nuance of the method itself? I gave a very brief overview of discounted cash flow. People have written doctoral theses on this, books. You can go ad infinitum on discounted cash flow and the detail that's related to it. You don't need to go that far, but do you actually understand some of the nuance of the detail of the method you're using? Because a bit of a danger to just to go into a method without fully understanding it. And as I mentioned, remember the next step that comes after the method in the umbrella approach. We start with the approach, we select the method. We need some way of quantitatively implementing that method, which is called the model. And that's probably in some ways a good way to end the IVS 103 overview, because I believe one of your next sessions covers valuation models themselves. I just mentioned that I'm just going to give you a very, very brief overview of what we do as a valuation professional organization here at AaRVF. We have our global Red Book standards, which essentially incorporate the international valuation standards. We're one of many VPOs around the world that incorporate IVS. But within those standards, we give a little bit more guidance and detail to our members and regulated firms about, for example, approaches and methods that might be particularly suited to the markets they operate in and the types of valuation they do. I'm not going to talk forever RSCS and Global Red Book because this is an IVS presentation. But if you are an RSCS member, or if you are an RSCS regulated firm, or if you're just interested in how we operate within our markets, and if you want to see an example of another VPO standards, within the slides, there's going to be links to our Global Red Book, our basis of conclusions, frequently asked questions, and some workshops that we offer as well, if you wanted a bit more further detail about RSCS. But that concludes my presentation today on IVS 103. And I can't wait to actually, rather than be standing in a room in London, come and join some of you on this call, some of the stakeholders within your market as I come to the IVS AGM in October. It's going to be very exciting, and I look forward to catching you up and seeing some of you there. I perhaps do have a couple of minutes for questions if there are any in the audience, but with that rider that's my specialise in commercial property. Thank you.
Thank you, Charles. Am I audible? Thank you, Charles. Am I audible?
Yes, I can hear you.
Yeah. I'm traveling by train, so there may be a connection problem. However, it's a wonderful presentation. I must appreciate. Everybody must have been enjoyed your presentation, and I did. So now the session is open. Before we go into next step, if you have any question, you can unmute yourself and ask the question to Charles directly, or you can put your question in the chat box, whatever you like. Of the IVS 103 is very important for the valuers, especially in the continent, because building, we are the basic. The land and building valuers, the real estate valuers are basic apply in almost in every real estate. The application of very wonderfully how a valuer can use the approaches and the methods. So now it's open. If anybody wants, please unmute yourself, tell your name and ask the question, or put the question in the chat box from where Charles can directly answer.
I'll just go to Sagata's question first, because can you use a combination of different approaches? Great question. I'll give you an example that's actually in IVS. The residual method itself is considered in some ways a combination of different approaches. So it might look at market-derived evidence. It might model and project the income that might be derived from the development asset. But of course, it needs to also consider the cost of construction of that asset. So within IVS itself, there is an example of where you would combine the approaches. What I would stress, though, is be careful about how it's framed and to be clear about the approaches that are used. And within, as I mentioned, the approaches that are used are different methods and models. So I would say as long as you're clear and transparent and explicit about it, there may be circumstances where not only you would use a different approach separately to consider your conclusions, but a different approach within the valuation itself. Thank you.
So we have a land and building structure. So in that, for the land, we can use cost approach, what I have done, and in the building,
so we have anyone else? Yeah.
Self-comparison approach. So there is a combination of approach. Can it be done in the IVS?
I can't hear I couldn't hear the question. I am sorry, my sound is not the best here.
Suppose there is a land and building married structure, a land and with a building. So for that land, I am using the self-comparison approach, and for I am using the cost approach.
That
in terms of separate consideration of land and buildings, potentially, how the valuation considers land and buildings, that can be an important question. I'm going to give a slightly valuer answer, I'm afraid, and say that it does depend on...
Let me explain you once again.
Apologies, you just lagged a little bit there. I didn't actually get the question. But what I would say that
there is a land with a building. Now you're getting my property. There is a land with a building.
Whether you value the extent to which you consider the asset or liability will depend on the intended use of the valuation itself. It might also be determined by, say, your local legislation, licensing regime, accounting standards within your own country or within international reporting frameworks as well. So it sort of depends on why you're doing the valuation and what regime you're following. And without the sort of analysis of that, I can't give you a more detailed answer. And I guess that also goes to the question that's been raised in the chat about the cash flow period itself. Again, it comes back to the asset being valued in the market that you're in, because you would be able to derive evidence. There would be best practice and protest within your individual market. I would also say, look at what's actually happening in the market on that. So what is happening from the investment side? How is the actual purchaser and investor in the property looking at it in terms of their cash flow periods? What's reasonable to determine as a cash flow period, and what you're doing as a terminal value at the end. I can't give you a sort of set of guardrails for the cash flow period itself, because the very principle that's set out in IVS is that it's high-level principles based, and that it must be suitable for the asset being valued and the purpose.
Charles, it is not generating any cash flow, it is purely residential building. So for the residential building, I am valuing for a bank loan. So for that, can I use the combination of approach? That for land, I am using market approach, sales comparison.
We will answer you. We'll answer you afterwards, right? Have understood. Fine. Ladies.
I'm very glad that it would be Sandeep taking that one as well, because it would come down to, usually it comes down to jurisdictional regulation, market practice within an area. In terms of that specific purpose and valuation type, it would be very dependent on the market. Sorry, Sandeep.
May I ask a question? Sir, when we use 3 approaches for one structure or one property and we get different 3 values, so how to choose the best of one, best out of it?
That's a great question, and valuation is ultimately opinion. It's subjective. It is going to come to different answers in many cases, and the different approach, method, or model that you would use would come to those different answers. I would say stand back and look, cross-check at the approach, method, and model stage that you've used. There's merit in sensitivity analysis, in scenario testing. With sensitivity analysis, you can look at what the key components of evaluation were and how much they impacted the end result. And once you've considered that, you can it gives you an idea about what might be driving those differences in the valuation itself. I would lean towards a preference, and this might be a personal view, to the valuation outcome that was most derived from available market evidence. If the basis of value is indeed market value or fair value, I would get back to what the market is doing, both in terms of transactions, in terms of sentiment, in terms of the processes of the participants. There would be my answer. If, for example, the cost approach, which wouldn't have any necessary link to market transactions, is giving quite an extreme answer, but an income approach based on realistic income figures over the last 5 years of the asset and looking at projections moving forward, I would suggest the one that was better derived from evidence linked to the market, where you do have that difference, might be the one to select. But you're right in your sentiment in terms of it's usually one conclusion that you would come to, and it rarely helps a client to be presented with ranges, different conclusions. That can be more confusing in itself. So sometimes it's a case of the valuer undertaking the quality assurance work in the background, the valuer undertaking the processes in the background to come to their single conclusion. I appreciate that in some markets there are you might be able to present ranges, you might be able to present alternatives, but generally in my experience it's one conclusion, and therefore you are making those judgments that you rightly identify when different approaches and methods come to different answers.
Thank you so much, sir. Got it. Thank you.
On Charles' question, I'm going to have to back out of that one because, as I mentioned, I'm a commercial real estate specialist. I don't value intellectual property businesses and the like. But sorry, hi Sandeep. But what I would say on the question of for the valuation of software itself, IVS, unlike me, isn't limited to a particular. Please. What I'd say is IVS isn't limited to a particular asset type and does have coverage both in the standards themselves and in the perspective papers, supporting materials, and the member participants that are well versed in valuing businesses, valuing intangibles themselves. And the great thing is that IVS has agreed those common principles, and a great example of that agreement is the 3 income approaches. For all the vastly different asset and liabilities we have all over the world, there are those 3 approaches. So the principles that we've talked about today actually apply to whatever you're valuing. If you're looking at the market approach, you might be looking at a comparable transaction method. You might be looking at sales of similar companies. If you're looking at an income approach, you might be looking at the income that the company itself derives. You might be looking at the value of the intellectual property itself, depending on the instruction and the purpose of the valuation. So it's not a great those overlying approaches apply whatever the asset type is. And sorry, exactly the same answer for plant and machinery as well. It's not something I'm a specialist in, but be reassured that the IVS principles that I've covered today cover all types of asset and not just cash flow. I'm just going through. I think that's all the questions answered. If you did have any further questions, I'm going to share my slides after this presentation, and do get in touch with me on LinkedIn. I like to have as much profile on LinkedIn as possible to share the great work that I'm doing with RSCS, with IVS as well, and to connect with people all over the world. So do connect with me. My email is also in the slides as well. If you did have any questions, I will again limit them to my specialism of commercial real estate, but I'm very glad that Sandeep has offered to support me with responding to questions that might be particularly suited to your market. So if that concludes today, I just want to say thank you for everyone for joining me this afternoon. Have an amazing weekend when it comes. Enjoy the weather. Thank you, Sandeep.
Yeah, thank you, Charles. Charles, Rahul here from AaRVF. Indeed, it was a very insightful presentation. And of course, we are going to share this presentation and hope to catch you soon in future presentations or webinars as well. And I would request everyone else, as Sandeep Dev sir is had to travel somewhere. You know, he's traveling at the moment, so so he's not able to you know talk to you or speak to you everyone properly. So if everyone may suggest, can we do this 1 hour session tomorrow, 7 to 8 p.m.? Will that be fine?
Okay.
Okay.
So
No,
tomorrow,
sir,
7 to 8 p.m., I will share the link so that he will be able to.
can we do it tomorrow at the same time?
So
3 to
Time
4, 7 to
7.
8 will not be convenient for us.
Okay, sir. We'll see if we can do it before also.
Yeah, 3 to 4 or 4 to 5 will do.
before 5, it's 4 p.m. is not possible to attend. I have some
Yes,
other.
7 evening is inconvenient.
7 p.m. will not be convenient. Yes, I do not agree with that.
5 is better.
Before 5 is better. Yes.
Okay, sir. So tomorrow is Saturday. If it is done on Sunday, Sunday is okay then?
Sunday also in evening, on suggestion, Sunday, if it is not possible on Saturday, then only go for Sunday. Otherwise, Saturday is more suitable than Sunday.
Sunday not possible, sir.
Sunday
not possible. Saturday would be fine.
Saturday would be fine, and that too during these hours, 3 to 5. 3 to 5, any 1 hour
Great.
at your convenience.
Okay, sir. 3 to 5 any 1 hour.
We'll just confirm it in on the WhatsApp group also.
Okay, okay, sir.
Right, sir. It will work. It will work. Thank you so much,
Thank
sir.
you so much, sir. Thank you for your convenience, sir. Thank you so much.
Thanks. Thank you. Thanks, Sandeep sir.
Thank you.